Welcome to the deep dive. Today, we're digging into a really core financial document. Think of it like a financial x-ray for a company.
The balance sheet.
Exactly, the balance sheet. And we're focusing specifically on how these are built using International Financial Reporting Standards, or IFRS.
hmm
The idea isn't just, defining jargon. We want to really get under the hood and understand what this statement tells us about a company's health. What are the signs to look for?
Yeah, absolutely. And it all comes down to a pretty simple fundamental equation, actually.
Uh,
What a company owns its assets,
right.
that has to equal how it paid for them. So either through borrowing liabilities or the owners chipping in equity.
Assets, liabilities, plus equity, the classic.
That's the one. And focusing on IFRS is important because it's trying to level the playing field globally. So, a balance sheet from a German company should ideally be speaking the same language as one from Australia. Comparability is key.
Yeah. Okay, so it's this financial snapshot. Why does it exist? What insights are we supposed to get from looking at an IFRS balance sheet? What's the real value for us?
Well, big picture, it shows the company's financial position right then, at that moment.
A specific date.
Exactly. But drill down a bit, and it helps answer some really vital questions like, can the company pay its bills that are due soon? That's liquidity.
Mm.
How about its long-term financial health? Can it handle its long-term debts? That's solvency.
Okay.
It also shows you the mix, how much debt versus how much owner investment is funding the company. That's the financial structure.
Debt versus equity.
Right. And I think this is quite interesting. It can even give clues about how resilient the company might be. Its capacity to adapt to changes or grab new opportunities.
That's really useful framing. So when we actually look at one, is there like a standard layout we should expect under IFRS, or is it a bit looser than that?
Um, IFRS doesn't dictate one single rigid format, no, but it does generally require what's called a classified balance sheet.
Classified. Meaning.
But it just means you typically group assets and liabilities into current and non-current. The idea is to easily see what's short-term resources and debts expected to be settled or used up reasonably quickly, usually within a year or the company's normal business cycle.
Got it.
There is a little wiggle room, though. Sometimes, especially for banks maybe, listing things strictly by how quickly they turn into cash order of liquidity might give a better picture. And IFRS allows that if it's more relevant.
Current versus non-current. Okay, let's tackle the own side first then. Assets. How would you explain what an asset is, like simply?
Okay, think of it this way. It's something the company controls.
Controls.
Yeah, because it's something that already happened, a past event. And crucially, the company expects to get some future economic benefit from it.
Like making money from it.
Basically, yes. Or using it to make money. So if you run a delivery service, your van is an asset, you control it, you bought it, past event, and you expect it to generate benefits by making deliveries.
Okay, clicks. Now, within assets, you mentioned current. What makes an asset current?
A current asset is generally something the business expects to turn into cash, sell, or consume within its normal operating cycle, which is typically 12 months.
Okay.
Or if it's held mainly for trading purposes, basically it's the more liquid stuff that's going to be used up or turned over relatively soon.
What are some common examples we'd see listed?
Oh, definitely cash itself.
Yeah.
And things very close to cash, called cash equivalents.
Like short-term deposits.
Exactly. Then you've got accounts receivable money customers owe for goods or services already delivered.
Right, invoices.
Yep. Inventory is huge for many companies' products waiting to be sold. And also prepaid expenses, think paying rent or insurance in advance. The benefit gets used up soon.
Okay, and are there any red flags associated with those? You mentioned receivables.
Yeah, well, for instance, if accounts receivable balloons, sure, it could mean sales are up. Good
Yeah.
sign. But it could also mean the company is having trouble collecting that cash from customers. So you need to watch the trend.
Good point. Context matters. What about the assets that are meant to last longer, the non-current ones?
Right, so non-current assets are pretty much everything else, assets that don't fit that current definition. They're held for long-term use to support the operations or maybe as long-term investments.
What kind of things fall into this category?
The big one is usually property, plant, and equipment, or PP&E.
Buildings, machinery, lands.
Exactly. Factories, offices, computers, the lot. You might also see investment property that's like land or buildings held specifically to earn rent or for appreciation, not for use in the business. Then there are intangible assets, things you can't touch but have value.
Like brand names, patents.
Precisely.
Yep.
Patents, trademarks, software licenses.
Yep.
And goodwill, That's a specific intangible that arises when one company buys another for more than the fair value of its identifiable net assets.
Okay.
And of course, long-term investments in other companies would also sit here.
All right. That covers the own side pretty well. Let's flip to the O side. Liabilities. How does IFRS define those?
A liability is basically a present obligation the company has. It comes from a past event.
Like borrowing money or receiving goods on credit.
Exactly. And settling this obligation is expected to lead to an outflow of resources, usually cash, but maybe other assets or services. It's what the company owes.
And like assets, these get split too. Current and non-current.
Yep, same logic applies. A current liability is one the company expects to settle within its normal operating cycle, or 12 months. Or it's held for trading. These are the debts coming due soon.
What are some typical current liabilities?
You'll almost always see accounts payable, money owed to suppliers,
Right.
salaries payable, or wages payable for employees, short-term bank loans or overdrafts, and importantly, the current portion of long-term debt.
Ah, so if a big loan payment is due next year, that piece becomes current.
That specific piece, yes, it gets reclassified. And, looking at current assets versus current liabilities, the ratio between them that gives you a quick check on liquidity. Can they cover their immediate debts? Too much current debt compared to current assets can be a worry.
That ratio is key. So non-current liabilities are just the longer-term obligations.
Pretty much. Anything that doesn't meet the current criteria. So think long-term bank loans, bonds the company has issued to investors that mature years down the line.
Okay.
Deferred tax liabilities, those relate to differences between accounting profit and taxable profit, and things like long-term pension obligations owed to employees.
Got it. So we've done owns assets and owes liabilities. That leaves the third piece, equity. What exactly is that under IFRS?
Equity is what's left over. It's the residual interest in the company's assets after you've deducted all its liabilities.
So assets minus liabilities equals equity.
Exactly. It represents the owner's stake, the shareholder's claim on the company's net assets. If you theoretically sold everything off and paid every debt, equity is what would remain for the owners. It's the company's net worth, in a way.
And what makes up this equity section typically?
Well, the main components are usually share capital. That's the amount shareholders originally invested to buy shares.
The initial investment.
Right. And retained earnings. This is really important. It's the accumulated profit the company has earned over time and kept in the business, reinvested, rather than paying out as dividends.
So profits plowed back in.
Precisely. You might also see a category called other components of equity, or sometimes accumulated other comprehensive income, AOCI.
That sounds a bit technical.
It can be. It captures certain gains and losses that haven't hit the main income statement yet. Things like adjustments for foreign currency exchange rates if they have overseas operations, or changes in the value of certain financial assets measured at fair value. It gives a slightly broader picture of changes in net assets. Okay, that clarifies the structure. Now, a big question, how do companies actually put numbers on all these things? You mentioned historical cost earlier, but are there other ways under IFRS? Yes, definitely. IFRS isn't just one-size-fits-all for valuation. It allows different measurement bases. Historical cost is one which you originally paid or received. It's objective, verifiable.
Simple enough.
But another major one, and increasingly used, is fair value. This tries to reflect the current market price, what you could sell an asset for or transfer a liability for in an orderly transaction today.
So more up to date.
Potentially more relevant, yes, but maybe less objective sometimes than historical cost.
And you mentioned others too.
Right. There's net realizable value, which is mainly for inventory. It's the estimated selling price minus the costs needed to finish and sell it.
Okay.
And value in use. This one's often used to test if long-term assets like PP&E have lost value if they're impaired. It involves estimating the future cash flows the asset will generate and discounting them back to their present value.
Wow. Okay, so several options. How does a company choose which one to use? Is it just up to them?
No, not arbitrary. The specific IFRS standard governing that asset or liability usually dictates or guides the choice.
Ah, okay.
For example, IFRS 9 for financial instruments often requires or permits fair value. IAS 40 might allow a choice between cost and fair value for investment property. But for regular PP&E under IAS 16, companies often stick with historical cost, though revaluation is sometimes permitted too.
So fair value is becoming more common.
It is, especially for financial items. The idea is it gives a more current economic picture. But the trade-off is that fair value can fluctuate, sometimes a lot, which can make the balance sheet numbers and even profits seem more volatile. So it's something to be aware of when you see fair value being used heavily.
With all these choices and estimates involved, it feels like you'd need a lot of explanation. What does IFRS require companies to disclose?
You're spot on. Transparency is absolutely vital. IFRS mandates extensive disclosures in the notes that accompany the financial statements.
Like the fine print.
Kind of, but really important fine print. Companies have to clearly state their accounting policies, how they are measuring things. For items on the balance sheet, they need to provide more detail, the nature of the item, how the value was determined, any key assumptions made, related risks.
What else?
They also have to talk about important stuff not on the balance sheet, like potential obligations, contingent liabilities, or significant contracts they've committed to. Details about share capital are required, how many shares are authorized, issued, and a breakdown showing how equity changed from the beginning to the end of the year. These notes are crucial for really understanding the numbers.
You mentioned specific standards earlier, like IFRS 9. Could you maybe list a few key ones that really shape the balance sheet?
Sure. Well, IAS 1, Presentation of Financial Statements, is the overarching one, sets the general rules for layout and classification.
Okay, the foundation.
Then IAS 2 deals with inventories. IAS 16 covers property, plant, and equipment. And IAS 38 is for intangible assets. IAS 40 specifically for investment property.
Yeah.
IFRS 9, as we said, is huge for financial instruments. And a really significant recent one is IFRS 16 on leases.
Ah, the lease standard. That changed things, didn't it?
Big time. It brought most leases onto the balance sheet for lessees. So companies now recognize a right-of-use asset and a corresponding lease liability. If you suddenly saw a company's assets and liabilities jump up a few years ago, adopting IFRS 16 was often the reason.
Good to know. Now, even with this detailed IFRS framework, are there still limitations? Things we should be cautious about when reading a balance sheet. It can't tell us everything, right?
Oh, absolutely not. No financial statement tells the whole story. A key limitation is still the use of historical costs for some major assets. In periods of high inflation, that book value might be way off the current market value or replacement cost.
So, potentially understated asset values.
Could be. Also, remember the estimates and judgments involved. Management makes choices about useful lives of assets, collectability of receivables, fair values. That introduces subjectivity.
Right. Different managers might estimate differently.
Exactly. And some really valuable things might not even be on the balance sheet because they don't meet the strict recognition criteria. Think about a company's amazing brand reputation, its skilled workforce, or internally developed customer lists. Often, those aren't recognized as assets under IFRS.
So, hidden value, potentially?
Or unrecorded value, yeah. And finally, maybe the biggest limitation. It's static, a snapshot on a single day. A company's position could look quite different a week later. You need to look at trends over time, not just one balance sheet in isolation.
Given those limitations, how well has IFRS actually done on its main goal-making companies comparable across borders?
I think it's fair to say it's made a massive difference. Having a common set of rules used in, over 140 countries now? That hugely improves comparability for investors.
So it's easier to compare a UK company with a Brazilian one, for example.
Much easier than it used to be, yes. The principles and disclosure requirements provide a common language. But perfect comparability? Probably not. Well, because of those measurement choices we talked about, cost versus fair value, for instance. And because applying the principles still requires professional judgment, which can vary. So while IFRS significantly levels the playing field, you still need to read the notes carefully and understand the choices a company has made. It reduces differences, but doesn't eliminate them entirely.
This has been incredibly insightful, really helps demystify the IFRS balance sheet. If you had to boil it down, what's the main takeaway for our listeners?
I'd say the balance sheet under IFRS is designed to give you a structured, pretty standardized view of a company's financial condition at a specific moment. It's built on that assets, liabilities plus equity equation. But to really interpret it properly, you've got to look beyond the main numbers. Understand the accounting policies, the valuation methods used, especially the trend towards fair value, which adds relevance but maybe complexity, and definitely dig into those disclosure notes.
They hold the keys.
They really do. Ultimately, think of the balance sheet as showing the company's financial promises and resources at that point in time. It's a snapshot of its financial DNA, and if you learn how to read it, it reveals an awful lot.
A snapshot of its financial DNA. I like that. Great way to wrap it up. Thanks so much for walking us through this.
My pleasure.
And thank you for joining us on the Deep Dive. We'll catch you next time.